Our next speaker is Jay Klein. He's Executive Chairman of Evolution Mining. Evolution is Australia's second largest gold miner with 5 operating mines and an economic interest in the Ernest Henry operation. The company now ranks as one of the world's lowest cost gold producers and has an average mine life approaching 10 years. I welcome Mr. Klein to tell us more.
Thanks. Thank you. It's really great to be back at Diggers and Dealers. And congratulations to Nick Georgetta, Suzanne Christie, the new senior sponsor, Canaccord Genuity, and everyone else in making Diggers and Dealers such a fantastic event again this year. Of course, on a sadder note, the one person missing this year, who we remember with fondness and respect, is John Langford. This is Evolution's 7th year of presenting at Diggers and Dealers, and I thought Ian finished at the end with the snapshot. I thought I'd start at the beginning with a snapshot as to where we're at. Clearly very different to where we were 7 years ago. Today we have a market capitalization of $4.8 billion, net debt of only $72 million, and have paid out 10 consecutive dividends, with the 11th due to be declared late next week when we release our full year annual results. We have a resource base of 14 million ounces and a reserve base of a little over 7 million ounces. What you'll see throughout this presentation is that we have a focus on profitability over production and quality over quantity. This is the reason we calculate our reserves at a very conservative gold price assumption of 1,350 Australian dollars an ounce, or approximately $1,000 an ounce. Those of you who follow Evolution will have noticed that La Mancha has sold down its holding and currently owns 9.6% of the company. Over the last 3 years, La Mancha has played an important role in our journey, and I'm heartened by the relative ease with which the market has been able to absorb almost $750 million of stock over the last 18 months and has enabled some high-quality institutions to either add to or establish a holding in Evolution. Our largest shareholder today is the Van Eck Funds at 13.7%. No doubt the 2018 financial year was enormously successful. It was the 7th consecutive year we met production and cost guidance, and we've only been in existence for 7 years, and it really reflected the true quality of our asset base. In the 12 months to June 30, we produced 801,000 ounces of very low-cost gold. Our all-in sustaining costs of $797 an ounce, or $618 an ounce, makes us one of the lowest cost gold producers in the world. Operating cash flow was $812 million, and net mine cash flow was $540 million. I'm sure you'll agree those are big numbers. Importantly, and this is critical, these low-cost ounces are delivering cash to our balance sheet, where our net debt was reduced by $326 million, and shareholders were rewarded with $110 million in fully franked dividends. The chart on the bottom right shows the tremendous success that we have had in bringing down our all-in sustaining costs, a reduction of 35% in Australian dollars and 51% in US dollars. This has been achieved against a backdrop of the US dollar gold price being down 27% over the same period, and the Australian dollar gold price being pretty much flat over that period. We have a strong belief that gold mining can be a highly profitable, cash-generating, dividend-paying business, and this is clearly demonstrated by FY18 results. There is overwhelming evidence that over the long term, the gold companies that have delivered superior returns to shareholders are the mid-tier gold producers. A portfolio of assets allows a more predictable, less volatile outcome. A mid-tier is large enough to fund its own growth and return dividends to shareholders, but small enough to also create meaningful growth. If you go back to the first presentations we gave in 2011 when we formed Evolution, we said we felt that there was a vacuum of globally relevant mid-tier gold producers in Australia. At that time, 2011, Newcrest's market capitalization was 10 times larger than the second largest ASX-listed gold company, and there was only one other ASX-listed gold company with a market cap above $2 billion. It really is a tribute to the success of the Australian gold producers that we now have a very healthy mid-tier sector. 12 months ago at this conference, I commented that the number of times the word record was used in the June quarterly reports that had just been released prior to Diggers was unprecedented. At the time, many were questioning whether that was as good as it gets for the gold sector in Australia. However, these last 12 months has seen Evolution and many of our ASX-listed peers go on to break new records in FY18. There is absolutely no doubt that the Australian gold sector is in great shape. In many ways, I think it's just a case of the Australian gold industry regaining its appropriate recognition as a premier low-cost mining destination. It is also reflected in the weighting of Australian gold companies in the GDX Van Eck Gold Index, which has risen from about below 8% a few years ago to over 15% today. And I think there's a lot more to go in that space as well, and we can grow even more. We are driven by some unwavering views at Evolution on the gold sector that haven't changed since we first presented the Evolution story here at Diggers in 2012. Firstly, we operate in a very cyclical industry. This is exacerbated by the fact that we in the sector seem to have an unconscious bias when thinking about our future that the gold price is more likely to go up than to go down. This has proven to be a dangerous assumption and has led to a lot of generalist investors viewing us as a boom-bust sector and one to be avoided. It has also meant that stock prices often advance too far and are overly optimistic on the up cycles, and likewise are overly pessimistic on the downside. I'm sure there are plenty of people in the room today who bear the scar tissue as witness to this. But as you'll see from this presentation, our approach at Evolution is to build a business that can prosper through this inevitable cycle. This means a strong focus and discipline on upgrading the asset base by selling lower quality assets in the upturn and acquiring higher quality assets in the downturn. It also means that you have to have the courage to swim against the tide. When things are at their darkest for the sector, that's when you need to be growing. And when everything seems too good to be true, then maybe it's time to think about selling some assets. We also have a strong view that gold companies are not scalable. Whilst that hasn't stopped advisors and bankers peddling this view, that there are benefits of having a large portfolio of assets in multiple jurisdictions, we think it's a myth. It's a strategy that has been tried, tested, and failed. Therefore, we have set ourselves a discipline of having no more than 6 to 8 assets, reflecting the reality that selling assets is as important as buying them. We hope we have developed a reputation for reliability and transparency, for always telling it like it is. A strong focus on reducing our all-in sustaining costs, increasing our cash flow per share and dividends, whilst also investing in our future to increase our average mine life. The investments and divestments that we have made over the last 3 years have reduced our all-in sustaining costs per ounce by $295 an ounce. One aspect that I think is often overlooked is that selling higher cost assets has contributed $65 to this $295 an ounce reduction. Yes, it's meant that we've produced less gold, but growing production is not our highest priority. Rather, our focus is on reducing costs and extending mine life to build a business that will be able to prosper through the cycle. To acquire Cowal and Ernest Henry, we borrowed $875 million, and in only 3 years, our net debt position has been reduced to $72 million. At the same time, we have paid $193 million in cash dividends to shareholders, and subject to the gold and copper price holding up, we expect to be net cash before the end of this year. Over the same 3-year time period, our EBITDA margin has increased by 32% to 53% for every ounce we produce. That's a very high margin business for any industry. Investing in our future is another pillar of Evolution's strategy. Based only on reserves, since 2015, our average mine life has increased from a little over 5 years to almost 10 years today. We continue to believe there is more to be found around our assets, and that is why we have committed up to $55 million in exploration over the next 12 months. In addition to our extensive exploration programs at our operating assets, we've also recently moved to secure earlier stage projects such as Connor's Arc, which is a very large prospective ground position in Queensland. As you can see from this list of projects, we've also invested in incremental opportunities to add value to the projects which we have. Here's a quick snapshot of our current portfolio of 6 assets, all of them in Australia. Our 5 operations are 100% owned, and the economic interest in Ernest Henry is operated by Glencore. On the y-axis of this chart is all-in sustaining cost margin. Assuming a gold price around the current gold price of $1,650 an ounce, our margin for every ounce we produce is $850. On the x-axis is mine life. Based only on current reserves, our portfolio now has an average reserve life of 9.6 years. On these metrics, I'm sure you'll agree that this is a portfolio of assets that will be able to fare better than almost any other gold company through a cyclical downturn, and will generate great returns in the good times, as we've demonstrated over these last 12 months. At this and other mining conferences you attend, you hear a lot about tons and grade. Whilst these are undoubtedly critical components and important, an aspect that is often overlooked is culture. It starts with the imperative of getting everyone home safely after every shift, but it is also so much more than this. It's about getting everyone engaged, no matter where they work or what job they do. It's about getting everyone to think and act like an owner of the business and do the right thing because they want to and not because there is a rule in place. That's why every permanent employee at Evolution for each of the last 4 years has been granted $1,000 worth of shares, and why we run an Act Like an Owner program that encourages and recognizes our people for coming up with ways to improve our business. We've had some fantastic improvements, big and small, successfully implemented as a result of this program. We also recognize that it is a journey, but if we want to be a great gold company over the long term, and that's something we aspire to be, it's a journey that we must go on together. Turning to Cowal, this is an asset we acquired 3 years ago, almost exactly 3 years ago in August 2015, and it really has been a truly transformational asset for us. In those 3 years, we've produced 759,000 ounces, generated net mine cash flow of $431 million. So in 3 years, we've paid back 56% of the original purchase price, which was $750 million. But we've added a net 1.4 million ounces to the reserve base, increasing it from the 1.6 million ounces when we acquired it to the 3 million ounces today. That's an increase of 2.3 million ounces if you account for the 759,000 ounces of mined and produced ounces. Since its acquisition, the operation has delivered a return on invested capital of 23% per annum. We've doubled the mine life to 2032 by committing to the Stage H cutback and are in the process of completing construction of an 800,000 tonne per annum float-tail leach project that will improve recoveries of between 4 and 6%. But there is much more. We believe that we have an underexplored province-scale opportunity and have set ourselves the challenge of increasing production from the current 240 to 250,000 ounces of low-cost gold that it produces in the last 3 years to over 300,000 ounces sustainably. There are 2 important aspects that we are working on to unlock this potential. Firstly, a plant expansion from its current 7.5 million tonnes per annum to 9.8 million tonnes per annum. We applied for this in Modification 14 that is currently advancing through the New South Wales government approval process, and we are also concurrently completing a feasibility study on this expansion. And secondly, and really critically to this, is the outstanding discovery success that our team is delivering. Currently, the Cowal mineral inventory stands at 6.1 million ounces of resource and 3 million ounces of reserve. All of these reserves are in the E42 deposit or sitting on stockpiles. So if you take the depletion out of E42, and it's currently got 3 million ounces of reserves, E42 on its own was a 6 million ounce reserve deposit. Last year, we established a maiden 603,000 ounce resource at the GRE 46 deposit, and we're continuing to get some very encouraging intersections, both as infill and outside the defined resource. But the grades we are intersecting are what's exciting us. You can see some of the recent results on this slide include 7.5 meters at 10 grams a ton and 1.6 meters at 58 grams a ton. To understand the significance, the current average reserve grade at Cowal is 0.81 grams per ton. I was talking to Glenn Masterman, Head of Discovery, VP Discovery this morning, and that GRE 46 maiden resource is over 600 meters of area, and the strike length where we've intersected mineralization is up to 2 kilometers now, and it's open to the south. As a result of this, we are increasing our discovery budget at Cowal fivefold from last year to $15 to $20 million this year. If we can increase the throughput to 9.8 million tons and add an underground source of higher grade ore, it really juices up this operation. The Ernest Henry economic interest gives us the right to 100% of the gold and 30% of the copper, and requires us to pay 30% of the capital and operating costs within the currently defined reserves, which is the mineralization above the 1200 level. The numbers on this slide speak for themselves. In the 18 months since we've owned this economic interest, it has generated $301 million of cash to our account. $219 million of that was in the last 12 months to June 30. The longer-term opportunity is to extend the mine life below the existing reserves, where we own a 49% interest. The Mount Carlton deposit was a deposit that the feasibility study completed in 2010 deemed to be uneconomic for development. Today, it would rank as one of the highest grade, lowest cost open pit gold mines in the world, having generated approximately $100 million of net mine cash flow in each of the last 3 years. At this operation, our challenge is to maintain these low costs and continue its exceptional cash generation. As visitors to our Mungari site saw yesterday, we now have a large footprint of prospective ground, a 10-year base case LOM, and an aspiration to restore this mine to a sustainable production rate of 150,000 ounces a year. We recently secured an important deal which removed pre-existing rights over the Castle Hill deposit and are getting encouraging exploration results in the Ora Banda area. It is an asset we are not going to die wondering about. Gold has been discovered in this Kalgoorlie area for 125 years, and we don't intend to die wondering about whether we can find more. We believe in the region and are committing an additional $15 to $20 million in discovery spend over the next 12 months. Last year, the mine generated $24 million of net cash flow, having produced 118,000 ounces, and in FY19, we're anticipating it will produce 125 to 135,000 ounces. Mount Rawdon and Cracow have been great assets to own. Mount Rawdon recently produced its 1.5 millionth ounce of gold, and last year generated almost $50 million. If it closed at the end of the current mine plan in 2025, which we do not expect it will do, it would have been going for 24 years. Not bad for a mine that the chairman of Diggers and Dealers, Nick Giorgetto, built and commissioned in 2001 with an 8-year reserve life. At Cracow, we once again have a 3 to 5 year mine life ahead of it after 18 months of exploration success. The challenge at Cracow is to continue doing what this mine has been doing for the last 15 years. That's to continue to maintain that 3 to 5 year profile in front of it and keep generating good cash flow. Last year, it delivered $37 million. 2 years ago, at my Diggers presentation, I cautioned that the gold industry shouldn't get carried away and behave like rock stars. The good news is that we've kept our heads and have had another 2 great years since then. But I'm going to repeat this note of caution as I conclude my presentation. We need to keep our feet firmly on the ground, something that is so well captured in this quote, which is on the screen, from the world's largest retailer and the world's richest man, Jeff Bezos, when he said, "A company shouldn't get addicted to shiny because shiny doesn't last." At Evolution, we understand and know this. We recognize the industry globally and domestically is facing headwinds, and that we need to work even harder to offset their impacts. We need to win back the confidence of the generalist investor and the frustrated global gold investor. And we will only do this if we are transparent, open, and honest, and continue to demonstrate that gold mining, and for us specifically at Evolution, is a highly profitable, cash-generating, dividend-paying, sustainable business that inspires its people. At Evolution, we're going to do this by continuing to implement our strategy that has been so successful for us this far. A focus on high-quality, low-cost, long-life assets. A recognition that our most valuable assets are not our mines, but our people. A significant financial commitment, and importantly, a strategic belief and support in our discovery team and their efforts. A strong financial discipline where we only do things that are accretive and in the best interests of our owners, who are our shareholders. And a strong recognition that we operate in a very cyclical industry where the only way to deliver superior returns over the long term is to build a business with a strong vision, values, and purpose that will allow us to prosper through the cycle. Thank you.
We've got time for a few questions. Are there any out there?
Go ahead, Keith. I can hear you.
All right, I can't disappoint you.
Wouldn't be the same being at Diggers without this.
That's very good. So what we call range of CapEx, we expect the plant expansion of Cowal from 7.5 to 20.9 million tonnes a year to be. Secondly, do you get all your approvals when you expect to get them? When you actually think you could be producing 8.9 million tonnes?
9.8 million tonnes. So the plant's done up to about 2 million tonnes per quarter, but we are limited from an operating permit perspective to 7.5 million tonnes per annum. Yeah, we think, and it's only scoping study numbers, about $60 million to increase the plant throughput. The oxide circuit, or the float tails leach circuit, gives us some really interesting optionality as well, because on the stockpiles there's some oxide material. You know, we don't want to predict the process of government. We've said that we'll get it hopefully in the first or second quarter next year. But in the submissions, when Modification 14 was put out for public comment, overwhelmingly there was positive response from the community. So it really depends on government. We've said first half of next year, calendar year, and then probably 12 months to build something. But we're concurrently doing that feasibility study.
Thanks.
Is there another question? Great, thank you very much.
Thank you.